Why don't we get this rolling? I know, timing's of the essence for everybody, so let's get going, man. Welcome and thank everyone for joining us today from around the country for this week's Pro Perspective, the Insider's Guide to all things CRE. I'm your co-host, Matt Kors here, Regional Director at Crexi, and we're zoomed in today with Patrick Luther, co-founder and managing principal, the National Net Lease Group at SRS Real Estate Partners. Patrick, good morning, sir. How you doing today?
Good, my friend. Thanks for having me.
Awesome. Yeah, no, we're excited to have you on here, man. So I'll give you a quick intro. So, you've done a lot in the short span of like a little over 10 years, $3 billion in commercial sales, actively transacted in all 50 states as well as internationally, advised on 1,000 plus transactions and top 5 retail broker, top 10 CRE broker nationally. Over 4 years ago, co-founder of the National Net Lease practice at SRS, which has grown nationally across the country. Today, managing a team of over 50 brokers and 25 offices and growing. Most recently, opening the Viva Las Vegas office. So congrats on that. And obviously, it's a bummer we couldn't meet at ICSC this year, but hopefully it's that much better next year in 2021 when it rolls around. But hey, man, you've done a lot in a short period of time. So, obviously we're excited to kind of hear some of your insights on the net lease retail space. From what you've seen in the past till now. Any opening comments or anything along those lines?
I think it's the biggest word search right on the or term used in this whole COVID situation is unprecedented, and I think the biggest thing that it feels like 2008, 9, 10 when I was essentially starting the business. So there's a bit of anxiety that's kind of permeating the markets and being reflected in conversations with owners. So we're working to advise on and change as much of that narrative as we can and focus on the positives and where the opportunities are. But it's a little alarming what's happening out there. So we can talk about what that means.
Absolutely, man. No, absolutely. It's funny. Let's get it going then. So obviously current economic times ahead of us, a lot of movement probably in and out of the space. So as you said, why don't you take us back to when you started, 08, 09, 10, 11? Just quick personal question. How come you got into net lease versus, let's say multifamily, industrial, or anything else out there?
It was kind of out of necessity. I graduated with a finance degree from Arizona State, and I was kind of out looking for work, essentially. All of the internships that I had thought were going to be progressing into full-time brokerage jobs disappeared, given the way the economy was going in 2008. So I just begged a retail leasing broker to join his team, and they slotted me in. I was the third or fourth guy on the retail leasing signs for shopping centers. So kind of organically working from there. The only product that was actually trading in 08, 9, 10 was credit tenant net lease.
Okay.
That trend is very similar to what's happening right now. When we look at over the past 90 days, what is actually moving, and I'm jumping ahead with the questions, but it very closely parallels 8, 9, 10. We were not able to in 2008, 9. I learned very quickly when I was leasing these centers that the debt markets weren't there, investors really weren't there, and owners, frankly, their rent rolls were getting so beaten up with tenants vacating, other issues, and collections were off that if they could hold the asset, they generally did because the valuations were so low. So again, kind of function of necessity. So.
Got it. Yeah. Well, it sounds like you jumped into a good space. That's for sure, man. From a growth standpoint, would you say just what you've seen over the past 10 years, is it the most competitive area in CRE? And what I mean by that is just how many shops and other brokers have popped up into the net lease space from when you started till today?
I tend not to like the reputation that net lease sort of has. And what I mean by that is that the barriers to entry are very low, frankly. I mean, you can work from home, pop up a Crexi or a LoopNet account, et cetera, and start listing properties publicly. If you have a phone line and you know how to read a lease, you can, you form Patrick Luther LLC and start selling buildings. So we tend to, or what I tend to do is, I work with owners, and I have $500,000 title max buildings for sale, but then I have institutional portfolios of big box department stores, ground leases under malls, et cetera, that are 70, 80, 90, $100 million and everything in between. So I work all ends of the spectrum. I mean, to me, there's no nobility in this. It's, I will work on anything that is saleable and that I can transact on. But, it tends to be, there tends to be an institutional end of the marketplace, but the private capital and the ability to transact on and access that, I think net lease is one of the more simple and easily accessible areas for younger brokers to gain some traction. As I've gotten older and further in the business, more of my work, even if it's net lease, it involves a private equity backed merger and acquisition where I'm handling the real estate in the form of a sale leaseback. I'm listing assets for sale, but I'm also renegotiating and assisting those landlords with extending those leases. So there are more nuances to what I'm doing. 10, 12 years ago, I would have just picked up the phone and, hey, look, you own a great building on a great corner. The cap rate's low. Would you like to sell it? Okay, fine. If you do that enough times, you'll find people that'll work. It'll work, and there are enough people that'll list buildings with you. But my conversations are they tend to be a little more strategic. Much of my net lease work is a function of looking at a larger shopping center and seeing how those net lease components can be carved off or parcelized separately to pay down debt. When these shopping centers have loans coming due and the rent roll is battered, or in the case of COVID, right, half the shops are closed, or the theater or the gym anchor is closed and they're not paying rent. If that owner needs liquidity, well, we need to go talk to a surveyor and talk about lot splitting and or carving off the Starbucks out front. So sort of portfolio management, asset management, sale leasebacks, that's the more complicated end of the spectrum of net lease. So that's what gets me excited about coming to work every day. But there are a lot of guys that make a very good living cold calling owners, and they'll sell 20, 30 dollar stores a year, right? It's boring. It's very much vanilla, but those guys look pretty smart right now because those tenants are paying rent. So
yeah, absolutely, man. So more consultative on your end, but at the end of the day, you can kind of get into space with whatever. I mean, there's probably going to be some kind of squeeze, I would think, or some kind of purge, if you will, at some point with
there's the brokerage business is very much, in a market like this, if things shift, folks they might own smaller regional companies, they won't want to carry that overhead, right? So they'll go look to, and I'm in kind of the middle tier, right? I'm not working with a public company. I'm not a Cushman Wakefield, CB, et cetera. I'm a middle market real estate services company, which is fine. I like not having the bureaucracy that comes with working with those larger shops, but those folks that have smaller regional teams, it's very expensive to run a brokerage company. The margins have come down and they continue to come down. And I think the biggest thing with net lease is that, the market is very efficient, right? When 15 years ago, investors would pick up the phone more frequently and brokers would do the same thing. And, you'd really have to have an in-depth and detailed conversation with an owner to get them to transact property. I mean, now, right, I can wake up on a Monday and I have 8 offers from Crexi in my inbox that just showed up, and I've never talked to the guy who wrote them. So that efficiency is very valuable. It allows us to get more done. But it's also going to, it's exactly what E-Trade and some of these other programs did for the traditional stockbroker. So as a service professional, you need to bring more to the table and you need to be able to add more value, which comes in the form of, again, negotiating leases, portfolio structuring, the consultants, right? I mean, if you're you're just putting the properties on the internet and e-blasting them around. I mean, that'll only get you so far, and you're going to see your continue to, the margins and the productivity of that continue to shrink. So
yeah, the spray and pray only works for so long, man. I get it. Well, hey, so let's transition to what's happening in the sector right now. We had a couple of questions come in, so let's start there. Have you personally seen in the medical properties a disappearance of triple net in favor of double net? Any comments you'd have on that? That's from Gene.
Very good question. If we're structuring sale leasebacks, the leases are traditionally done in an absolute triple net way, right? The tenant, if the tenant owned the building before and they're reselling it, it would be logical that they know how to maintain it, et cetera, et cetera. But for the most part, your build to suit, so your new construction, if it's medical, dental, et cetera, I mean, most of the tenants are gravitating toward a double net lease. And how to define double and triple net is always an argument, right? And
right.
You know, we get in a little email debates with brokers that are, that inquire on our projects and said, oh, this is false advertising, this is double net. Well, I would argue that nets are taxes, insurance, and CAM. Absolute net, by definition, means that every component of the building is maintained by the tenant, but the building is still triple net if the landlord is responsible for the roof and the structure. It's just they have to replace those items at some point. If there's so many definitions and nuances to triple net, but for the most part, to answer the question a lot more specifically, the developer builds the building, he gets warranties from the roofer and the other component general contractors that install the components and parts of the building, and that new landlord that's acquiring that building typically does have to maintain that roof and structure. They then go to those, if any of those components and parts fail, they then try to go collect from, the roofer if it's under warranty, et cetera. So case by case.
Got it. Yeah, for sure. Are you seeing just in general?
Away from the less a tenant can maintain, the more of that they can put on the landlord, the more favorable that lease is toward the tenant. And, in a good market like now, that the tenants can get away with, writing leases that are more favorable to them. So.
What's wrong with that? I mean, are you seeing in particular, like, like a niche tenant maybe right now, like how we had the dollar stores back in the day, like you mentioned, or even how you mentioned with medical care, like, is that hotter? Or anything maybe you foresee in the future going to be that new Dollar General of the COVID days?
So what's really the medical, this isn't even a real word, but the retailization of the medical industries is creating more net lease opportunities with a medical tenant base. So hospital systems, right? They're doing Banner Health, Honor Health, Dignity Health, all of these large systems. I'm sitting in Arizona right now. Well, it used to be that you'd go to a 300, 400, 500 bed hospital to get your care. Well, now they're building urgent cares in your neighborhood, freestanding urgent cares. They're building surgery centers, emergency rooms, those sorts of things in these suburban communities and spreading them out from the actual core hospital itself. More and more of that care is going to go into these outpatient facilities. So those are now net leased investments, and they're viewed as very much Amazon proof. What's been interesting to see during COVID, believe it or not, is a lot of investors you would think it would be intuitive to think that, medical uses are going to be very much in favor. They're very busy right now because of COVID. These tenants should be doing very well in this type of environment. I want to buy medical buildings. You have an urgent care on the screen right now. The actual numbers when you speak to the urgent care operators and a lot of the medical professionals is COVID has scared the patients away such that if they're quarantining at home, whatever it might be, they're scared to come in and simply do their routine checkups. So the actual numbers for these medical facilities are actually down. The numbers I've been hearing, even the urgent care space, the visits for the little procedures to check this out, check that out, the overall revenues are down 20 to 25%. Now they're still paying rent, right? The revenues aren't at zero like they are with restaurants, where they can't afford to continue to pay. But I was a little surprised that the data came in that overall hospital visits are down, fewer procedures are taking place, and revenues are down at all these facilities. So
Yeah, man, that's crazy. I didn't think about it like that. People are just scared to go out and get your routine checkup. It makes sense though, I guess, with if you watch the media too much. Hey, so another question came in. Retail urban area spaces with mixed use developments. You see not potential buyers if they have been like specific leases with retail in there and stuff like that. Any issues on getting buyers at the table on those deals?
So the offer activity that I have across 500 listings I'm watching right now, right? We've got about $2 billion on the market. We've been picking up more LOIs on a daily, weekly basis. Every day that we've gotten, every day and week, things have tended to improve. So the market is normalizing. There are significantly fewer offers on retail. We're getting more offers on medical and industrial product. The biggest problem with transacting any form of retail is debt right now. The multi-tenant retail we sell, because I do a lot of that work in addition to Net Lease. That transaction volume for us is down about 90%. No one is buying
on the multi-tenant is.
Yeah. Anchored retail shopping centers are not trading right now, and it's because the rent collections are so far off, right? Until these landlords stabilize their rent rolls, to add to that, the lending market is not there. So I'll give you an example. Even on a cookie cutter, net lease deal, right? If I could have put a 70% loan on that property prior to COVID, that lender will still do that transaction now, but they'll want the buyer to put 40 to 50% down. The leverage has gone down significantly. The down payment has gone up. So the result of that is, right, the investor wants to pay less for the property because they're getting less positive leverage. So, that you can still get through transactions on 2, 3, 4, 5, call it 5 million and under net lease. But when your down payment percentage changes by 20% on a $30 million shopping center, all of a sudden the buyer just doesn't have the money. And so the seller's not going to go reduce the price by that differential. They're just going to hold on to the asset. So I think that the traditional or the anchored shopping center market's going to remain pretty depressed here for another 6 months or so. There's no CMBS market right now. Their securitizations are not there. So that's another point. There's essentially no non-recourse debt available right now for retail, or at least very little. So the buyer's now having to put more down. They're also having to take recourse. And so that eliminates a huge component of the buyer pool. I mean, I'm looking at this question, your syndicators, your fund managers, your guys that might look at buying an asset, raising money from friends and family. Well, now that guy has to sign personally on the loan. It's not going to happen.
Not happening, yeah.
So
too much risk.
Yeah.
Dang. How about like to go on that question, like geographically speaking, are you seeing like maybe like the Southeast is more, people are more on fire there because they've kind of been open the whole time during COVID, or, Arizona maybe versus California? Any specific geos? Because I know we're pretty scared over here in Los Angeles where I'm sitting.
Yeah, so I've been telling everybody how nice it's been to be in quarantine in Scottsdale, Arizona. I could go hiking, golf courses haven't closed, et cetera. And there's a graphic with a map that just showed that Arizona is the #1 state in the country now for a second spike in COVID cases. So terrible. But what is happening consistently, and we've heard it from multiple investors, is the way California is responding to COVID, the draconian measures that California is taking, and the potential laws that are being proposed that would allow businesses, tenants across the whole spectrum, right? Apartments, retail, office, et cetera, allowing tenants not to pay rent, or providing mechanisms where, again, that seller cannot collect. If those things are passed into law, it's already happening where owners are saying, get me out of California. I'm so scared
I can imagine.
going to go into place. I'm very nervous about how restrictive the state has been on these businesses and allowing them to reopen. That's going to impact the viability of my rental income stream. I want to be in a more, a state with a different political orientation or a different attitude toward allowing the businesses to free enterprise and allowing the businesses to reopen. So yes, to your point, there's a lot of these wealthier, older California owners are saying, trade me out of it, get me into Texas, get me into Arizona, et cetera. So generally Sun Belt markets. If we talk about geography, there's been, you take the country and you draw a smile, right? You start in Washington State and work your way up to New England, and the flyover states and or the kind of depressed Rust Belt markets in the center of the country tend to get skipped over. There are exceptions that are healthy, Chicago, Omaha, et cetera. But, in general, the investors tend to like to buy in that band. So.
How about like who is buying and selling right now? Are you seeing, are you getting a lot of buy side activity still from your 401k baby boomers, trying to get that mailbox money, or are the net lease REITs out there buying and selling? What's the deal there?
It's hard to, I've been busier than I have ever been over the last 60 days. But it hasn't been transactional. It's been, a lot of advisory, consulting, and conversation. Okay. What the hell do we do, right? I feel like a psychologist for rich people that are having trouble collecting.
Hopefully you got good rates, man. Hopefully you got good rates there, like a doctor.
Yeah, well, everyone's trying to figure out what's going on. And if there's any ambiguity with the tenant, that asset is getting passed up in favor of others. And what I mean by that is, if you have an issue collecting, if you have a theater, a gym, a casual diner that's closed, I look at everything I've sold over the last 90 days, and the investors, if they have to invest, are gravitating towards credit. And I would have told you 2 or 3 years ago, investors were starting to shy away from dollar and drugstores because the leases are flat. There was no rent growth, and they were very excited about experiential tenants, restaurants, these sorts of things. They have rent growth. People like to congregate. It's completely flipped.
Yeah.
People were saying, look, I would have never considered a dollar store. I don't buy flat leases, but at least if I buy that, I'm going to get paid. The drugstore, the frequency of offers and the amount of offers we're getting on drugstores has improved dramatically. It used to be that there were too many dollar stores on the market. There were too many drugstores on the market. So there was just too much supply. Well, a lot of that supply has been absorbed now. And I'm sitting on too much restaurant inventory. So if you look within the restaurant space, I can give you Arizona as one example. In the past 90 days, I don't think there's been one casual diner that has sold. Wow. If you look at what's sold in the last 30 days, Starbucks, Dutch Brothers Coffee, Black Rock Coffee, Dunkin' Donuts, KFC, Taco Bell, et cetera. Every single building is at a drive-through, with a lot of emphasis on coffee shops. So
anyway, that's good. Quick transition there. Then, we had a question come in: distressed properties right now, potential during or after COVID. Any specific, what are your thoughts on that in general?
It's the amount of calls I've gotten from investors saying, where's the buying opportunity? Where do we make money? Where's the distress? My answer has been, it's coming, but it's not here yet.
Okay.
I have not seen there have not been distressed sales and or fire sales taking place because the businesses are existing on or subsisting on PPP money. My concern is in 2 or 3 months here, when that PPP money runs out, I think you're going to see another round of layoffs because these folks can't afford to carry people on their payroll. Stimulus is going to wear off. I think we're in for some choppy waters ahead, but owners have received, and lenders for shopping centers, retail assets, net lease, et cetera, lenders are cooperating with borrowers. They're giving 90-day deferment of payments. They're adding those payments to the balloon. Well, what happens at the end of 90 days and the tenant is still not paying rent? They still haven't reopened. If you can hold on to a property, and you're a landlord, and if you have recourse on a loan, you're not going to just dump it if you don't have to. So it feels like there's it's a pressure cooker, right? And the steam is building, but things, I think we have a Band-Aid on a leaky dam, and it hasn't broke yet. To have, and I don't mean to be doom and gloom, right? There'll be opportunities, the strong will survive, et cetera. But yeah, I do think there's a lot of distress that's coming. You've already seen a wave of retail bankruptcies, but I think there's going to be a total second wave once again the stimulus burns off. So,
Yeah, no,
but
for sure, man. Good.
I've got every day I get somebody trying to offer me a 7 cap on a new 10-year build to suit Starbucks, and it's like, guys, the median cap rate's 5.25, and frankly, this stuff is just as valuable during COVID because it's one of the few tenants that can actually pay rent and stays open. We're not having an issue clearing those investment grade credits. The cap rates didn't go from 5 to 7 overnight. It's just ludicrous when we see bids like that. But then you go to that investor and say, hey, if you really want an 8, 9, 10 cap yield, I can show it to you. It's a gym that's not paying rent. It's a theater.
Yeah.
Nobody wants to buy that. So it's either you have 0 offers or the frequency of people that are just lobbing and lowballs is wasting my time has increased.
Well, talking about time there too, like, are you, do you see, and this is kind of a crystal ball question I'll probably ask later, like the seller and buyer disparity on getting a deal done, right? I mean, I'm assuming the market was getting hot, really hot. So people were saying it was taking a lot of time to get deals done anyway, right? Just with pricing being off.
Buyer-seller price expectations are wider than ever.
Yeah.
Buyers think things should be cheaper. Sellers think the world hasn't changed. It's a case of haves and have-nots depending on where you are in the market. The reason why pricing hasn't changed on investment grade credit is because if you take your website in general, right? If you look on Crexi, and I'm going to make a blanket statement that's probably not totally accurate, but I would bet that half of the inventory advertised by brokerage companies is not viable right now, right? It's still advertised for sale. They might still be marketing it. I crack up when I see people e-blasting, to your point, closed theaters, gyms, et cetera. I feel badly about just beating up on these categories. Childcare facilities. No one is making offers on that product. It's not saleable right now until those businesses reopen and the tenants get current. But what that creates is a supply problem, right? It's everyone's chasing the same thing, and there's only a very small percentage of viable tenants that are current. So overall buyer demand is down, no question about it, but it's all chasing the same thing. So we're really not seeing a ton of price movement across the credit stuff. So
okay, that makes sense. We had a couple questions come in from the audience. What tenants would you say defend equity best regarding lease term, or does that exist in Net Lease? I guess you're probably talking about the credit ones, obviously, but
repeat it real quick.
What tenants would you say defend equity best regardless of the lease term, or does that exist in Net Lease?
I really like Sherwin-Williams. It's deemed an essential business. It's a paint store. If you read their 10K, they've occupied their average building for 28 or 29 years. They have not changed their retail footprint. 4,000 to 5,000 foot buildings, bread and butter business. You can't ship paint online. It's a health hazard. It's too heavy and expensive. People need to come in and sample it. It's S&P BBB credit. Sherwin, I think, is a very good defensive tenant. Dollar. I do have concerns about drugstores. I think they're too large in general. We're seeing them get smaller and smaller. We could have a whole conversation about that. Home improvement, Lowe's, Home Depot, I would invest in those all day long. Again, products that are too cumbersome and difficult to ship and export on. If somebody's doing a job, they need to go get those products during the day. The grocery store business is often cited as something that is very defensible, but there's disruption there. There's disruption in how people get their food, where they want to shop, et cetera. So the really defensible stuff is extremely difficult to find. A lot of what's happening is owners that have those buildings, right? If you own a Costco, Home Depot, Lowe's, Walmart, et cetera, if you're under pressure with other assets and not collecting rent, some would say, oh, maybe that forces that owner to sell. that could be a correct answer in some cases, but the flip side of that is owners are saying, hey, this is my good asset where I'm actually getting rent. I'm not going to sell it. So supply is very, very tight, especially on the defensible stuff. So
Yeah, no, that makes a lot of sense. Maybe some good stock picks there too. Sherwin-Williams, Home Depot and stuff.
It's a good one because that a retail investor
Yeah,
can access that. The buildings are, you can find them for 500 grand in various parts of the country. Most mom and pops you aren't going to go just buy a Home Depot building, right? So
yeah.
great institutional.
Another cap rate question came in just on your 5 versus 7 comment, and again, what we asked earlier, geographical parts of the country. Any places where you see higher cap rates happening, or is that stuff just with the bread and butter stuff not gonna switch?
Sure. No, sure. It's always you have to compromise on demographics, right? If you'll tolerate thinner population demographic, I mean, I could take any blue chip credit tenant and market A and market B, right? If market A is urban infill Dallas, right, and market B is Sheboygan, I think that's in Wisconsin, whatever it is,
Yeah.
that cap rate spread for the exact same property could be 100 basis points. So there's a reason why when you look at a lot of the public REITs, it's relative on the net lease side. Most of them don't have heavy concentrations of product in California, New York, Florida. These are very, very expensive markets that retail investors will come in and out and pay. So
yeah, that makes sense. A couple other questions came in. So from a tenant's point of view, are landlords tending to give more TIs or less TIs if you're looking to get into a space?
Very, very difficult to answer, very much case by case, but as a macro trend, you are seeing tenants that are going to be relying more and more on developers to fund their construction, their build out. So to answer the question, the trend is toward more TI being provided by the landlord. A very obvious answer to why that's occurring is tenants are trying to preserve cash. You are going to see fewer ground leases occurring where the landlord just leases the dirt and the tenant builds the building at their cost. I don't care who the tenant is, if it's Chipotle, Chick-fil-A, et cetera, even if they're very well capitalized. If these guys are trying to build 50 new stores a year and those buildings cost $1 million a pop, well, why would they outlay that cash when they can have a developer do it for them and pay it back through rent? So as liquidity becomes more challenging, and as the capital markets tend to tighten, I think you're going to see tenants wanting to put less of their own money into the facilities. So
that makes sense. That makes a lot of sense. I was going to ask this question later, but you kind of brought it up. So like, kind of a crystal ball question. If we're hearing all this stuff like the 10-year office lease for, 3 floor plates may not be needed in these skyscrapers anymore. Like, do you, in your opinion, like with you guys and, Newport Beach or Dallas, do you see like your space maybe constricting, or is it too early to tell on that front? Just because people don't, people can work from home now, right? They're starting to figure that out.
They can, and I'm probably violating every HR code that my company has, but, I think the whole work from home thing is a millennial snowflake fallacy. And, it's nice and convenient for people to, and I'm a millennial myself, but I think it's very convenient for people to work from home, but I can tell you with absolute certainty, I'm not getting the productivity out of my employees that are working from home. I can't force them to come into work. But I suggested that the office was reopening, and it was interesting. Out of 70 people in my office, I would tell you that about 90% of my employees, colleagues, et cetera, above the age of 35, 90% of them have returned to the office. They're coming to work. They want to get out of the house. They don't want to have
that makes sense.
Crying, falling all over them. But it's the total opposite under the age of 35. 90% of my employees are scared, afraid, et cetera, et cetera. And I take this very, very seriously. And so I allow them to work from home. But it's very interesting to see how the demographics perceive, their productivity working from home. If it were up to me, I wouldn't allow it to happen, but that's not, that's would be fairly insensitive of me at this time. A macro trend is that people are still going to need to occupy space, but the average space per worker is going to expand again, right? It got to the point where in the 80s, The average person had 300, 400, 500 square feet per body. Now it's down to 100, but those communal workstations and desks where people are jammed in like sardines, that's going to become more infrequent. People are going to spread out among the space. So I think the absorption of office space will still be there, but the net effective rents are going to go down. You're going to put fewer people into that space. And the landlords to keep the buildings full are just going to have to discount rents. I think the office sector is under a lot of pressure. So.
Do you see, so like, again, back to the crystal ball thing, anything like that maybe happening in your space with either the tenant side or the developer, like not wanting to do a 10-year lease, a 10-year triple net lease? Would they want to try to cut it back to a 3 or 5 year lease? And does that kind of, if that happens, does that change everything in the whole space there?
It's a really good question. I mean, if there's upside in your rents, you cut short-term leases, right? If the value in your asset, the financing options, the debt, et cetera, if you need the longest lease term possible to get the lowest possible interest rate in general. It's not a one size fits all answer, but if you're going to just stick that asset on the shelf and not think about it again, you want a long-term lease. But if you're tinkering with and trying to raise rents and improve your buildings, you want short-term leases, right? I don't. There's a whole tax component that goes to answering that question too, is how leases are treated on company balance sheets. But it's such a, if I'm in a tertiary market and I have a very purpose-built building, I want the longest lease term possible because all the value's in that lease, right? If that, in scenarios like that, right? If the tenant leaves, you're getting 20 cents on the dollar, right? You want a very, very, very long-term lease in that case. So.
Okay. Yeah. No, that makes a lot of sense. What do
you?
you?
Okay, a lot of TI, you want a very long-term lease. You know, if you're building a very specialized building. So.
Do you think the tenants are going to get scared of signing those long-term leases though? Just
of course.
Right now. Yeah.
They're all. Every credit tenant is every couple of years the general trend is they want less square footage and they want a shorter term lease. All the leases have gotten shorter, right? If you look at drugstores, Walgreens, for the Proto forever was a 25-year lease. Then it went to a 20. Now it's a 15. Now they're doing 10. I have new small format Walgreens that we're listing for sale, and they're 5-year leases. They're little stores, primarily pharmacy only. They're 4,000 to 5,000 feet, but those come with 5-year leases. So. Dollar Tree, it used to be the 10-year lease. They're signing 7-year leases now in some cases, and they're asking for that. Starbucks, in many cases, is saying, hey, if they really want your site and you have a trophy piece of dirt, they'll still give you a 15 or 20-year ground lease, but very, very uncommon. The typical format is a 10-year lease, and now they're saying they want to kick out at year 5 or year 7. So everyone's looking for ways to shorten the term.
Interesting, man. Thanks for that insight. Couple questions came in from the audience here. What would you say to a new CRE broker considering a retail specialty in this climate?
Don't do it.
You heard it first here from the expert, folks.
It's you can make money in whatever segment of the market you're in. You can have a very good career in any segment of the market. Specializing in something is valuable, right? These are generic comments, but if I had to do it all over again, I would probably have started working in the medical space or industrial.
Okay. Interesting.
Retail's been very good to me. There's no reason for me to get out of it at this point, and I know enough about it now to be dangerous, but it's probably one of the more challenged categories across net lease. Aside from hotel, retail is about as complicated and challenging as it gets.
I see what you're saying there, man. Well, how about, I know we kind of talked about this a little bit, but like financing options today, just to kind of switch the note here. I know that's a big part of, what you do every day, and I don't have too much knowledge in this space, but like, is everything kind of just to a halt, would you say, besides the comments you made earlier?
Yeah, it's frothy. There's limited non-recourse debt out there. To be an effective broker and to effectively represent your sellers and do a good job as a service professional, qualifying debt, I think, is the number one thing that brokers on the other side of the table from me when we're negotiating. If I'm representing a seller, they're representing a buyer. It's the biggest misstep or area where they fail or underperform. And what I mean by that is I get an LOI from somebody, and sometimes it will have no information on the buyer's financing at all, which that's red flag number one. Or number two, it will have very specific information. It'll say, we need an 80% loan, non-recourse at 3%. And my first question is, are you aware that this is totally impossible and not feasible to achieve, right? And some people, they'll comment, oh, the buyer has great credit. The buyer has great relationships with banks. That doesn't mean anything. I have great relationships with banks. I can't get that loan, right? I mean, I have a mortgage broker that works with us in our own office, right? And qualifying debt or the lack of debt is the number one thing it's one of the number one things that's blowing up transactions right now. So
Okay.
if you're doing LOIs and you've got a listing agent on the other side of it like me, I'm not letting people go under contract with me unless I've spoken to that lender, unless I've seen that term sheet from that bank. And these vague comments of, oh, the buyer banks with Wells Fargo, they know what they're doing. Well, half the time the buyer doesn't know how to read the term sheet from the lender, right? The term sheet might say, oh, a 70% loan, but then it will say interest reserve and all this other stuff. So they don't realize it's 70%, but then they got to go put an extra X amount down because of the reserves. So it turns the loan into a 55% LTV loan overnight. So it's getting through and qualifying that lender and making sure that lender can actually perform is very, very, very critical right now. And if you're not doing that and managing that process, you're going to be left at the altar after an escrow process. Everybody's going to waste a bunch of time, money, et cetera. So, sorry, this is just, you got me on a tangent. I'm fired up about this one because I've so many people with these bogus loan requirements in their offers. So
let's hear it, man. I like hearing it. Just on that same tangent, do you think, like, are people wanting to see, okay, so I want to see how many months they're going to pay rent and stuff like that? Like, do they want to see, they paid rent for the past 3 months and what's going to happen over the next 3 months, stuff like that.
Yeah, no, so to get a lot of transactions done, sellers have been having to master lease post-close. And you can call it a master lease, or you can just say, hey, the seller will prepay the rent for, we've closed transactions where the seller's prepaid 9 months of rent post-close. And this wouldn't be if it's a shopping center or net lease. It's usually not the whole rent roll, but if you've got a 3 to 4 tenant building and a couple of those guys aren't paying, if you're a smart buyer, you're asking the seller to backstop that for a period of time. Most sellers are not pushing back on or disagreeing with the request for 90 days. If their tenant's not paying, or they paid partial or not at all in March, April, May, that's a reasonable thing for a buyer to ask for. My clients that I'm listing for probably don't like me hearing that, or to hear me saying that. But those are the kind of things you need to do to get transactions done right now. You put 3 months of rent in a holdback, right? If you sell the property for $5 million, whatever the rent's $50,000 a month, call it. The seller gets $4,850,000. The $150,000 sits in an escrow account. If that tenant pays rent, the $50,000 is released. If the tenant pays rent again, another $50,000 is released until the tenant catches up. So
right, okay. I assume that's a case by case basis on a lot of deals too. But yeah, got a good question that came in here. So it seems a lot of developers have been firing on all cylinders in the past few years, presumably to capture low interest rates, correlating to lower cap rates and higher prices. How much more runway do you think exists in the new build single tenant net lease developments, and what will or could derail that for developers?
So tenants in this environment, the healthy ones are going to take advantage of and upgrade their locations, right? So you're going to get, if one retailer goes bankrupt and they have an A location, this is what Ross did in the last cycle, right? So Ross was in B and C locations and they upgraded to A's because the high rent, the Ultimate Electronics of the world, the Barnes and Nobles, the Borders, these have really nice high image spaces and lifestyle centers for the most part. Ross could come in there when Borders went BK and Borders was paying $15 a foot, and Ross comes in and says, hey, I'll take it, but I'm going to pay 7 or 8. So you're going to see those certain tenants and developers, there's going to be relocation activity. organic retail growth and development is going to slow down. I would tell you a lot of the very intelligent people I know have developers for retail have shifted their focus. They're shifting and orienting toward medical. They're orienting toward industrial, getting into other asset classes, because I think that the pace at which retail was growing and expanding since we've gotten out of the Great Recession, that's going to slow down. The other issue you're going to have is you're going to have cases where I'm already seeing it. You know, Steak and Shake closed 150 locations. Ruby Tuesday, another tenant, closed 150 locations. So, well, now you've got 2 vacant buildings on both sides of the street. So that's going to depress values. And what's going to happen is when those things occur, those vacancies occur, that developer doesn't need to go buy a piece of raw land anymore. He's going to go buy that existing building and repurpose it. So fewer land transactions, things like that. So
that other question just came in. Your thoughts on new construction versus existing? So it makes a lot of sense.
More and more rehab and repurposing. It's particularly in areas, California, areas where it's very difficult to get approvals for drive-throughs, things like that. Repurposing buildings is just so much quicker and easier to get that project online. We have heard, and this was one of the most interesting Zoom calls I've had during this whole COVID thing, is with the governor of Massachusetts and a group of real estate developers. And he was saying he's putting a lot of emphasis on getting these cities and towns to loosen the restrictions on drive-throughs, to allow more drive-through permitting.
More drive-throughs.
To allow more, and it used to be, and especially in California, right, the environmental folks don't want more drive-throughs, but now people want to be outside. There's going to be, I think you're going to see similar square footages for buildings because people want to spread out, but there's going to be more of that building envelope is going to be some sort of a covered patio, some sort of an air-conditioned outdoor type of experience. The formats, there's going to be more walk-up and take-out windows. So it will be nice to see, and a lot of these developers are going to be very pleased if these cities do start encouraging permitting on drive-throughs and making things easier to get businesses open. So
more drive-throughs, man. I know there's a moratorium on them here in Santa Monica, so that last Chick-fil-A that opened up was hot when it went on the market. What are your thoughts? So we had a couple questions come in. Fast food restaurants. Would you say those are going to be hot versus regular restaurants? I take it with a sit-down experiential.
The demand is already spiked on those. It's very challenging. The cap rates, I don't think we're going to see a tremendous amount of cap rate expansion, regardless of what the economy does. Fast food drive-through buildings are highly defensive. You're going to see a large amount of cap rate expansion on casual dining. It's already starting to happen. Sorry, I didn't mean to talk over there. So how about some, how good is the news? Can it be relied on? For instance, Starbucks announced closing 400 stores in North America, 200 today in Canada. I'm building 2 of them, so hopefully the narrative starts to change a little bit. The news is very frothy. The stock market, and particularly in the retail sectors, the index of mall REITs went up 30 to 40%. Put $100 in the stock market across Simon, Macerich, et cetera, you would have made 30 something plus % on your money last week. This week, they gave back about half of those gains. So in 1 week, you have a jobs report, and the information cited was that, the economy added 2 million jobs. Well, we still have 20 million some odd unemployed people. It's just less bad. And that was the news article that came out last week. So the stock market popped for a 5 to 6 day period. The markets are very fickle. They're very volatile. The biggest thing that Starbucks did in particular that made things challenging from a practitioner or sales agent's perspective is the 28 or 29,000 letters that went public that said they want some form of rent concession, abatement, et cetera. We started hearing buyers say, look, I may have really valued that Starbucks lease. I'll consider a Dutch Brothers coffee. I'll look at a BlackRock coffee. I'll look at a Dunkin' Donuts building. So yeah, COVID, I have a list that we're tracking internally of 500 plus tenants with exactly what they've done, asked for, et cetera, in the form of abatement. And the bad actors and the people that just don't send their rent check, even when they have the cash and the balance sheet to do it. I mean, that how people have behaved in this crisis has been very, very interesting. And I think a lot of people are going to remember that for a long time. The national tenants have been, some of them have taken the approach of, hey, we're just not sending rent, sue us, right? So do you want to engage in that to force a tenant to pay the rent? In some cases, even when they're capable. That's unfortunate that you have to do that. The mom and pop tenants in many cases, these are people that you can get them on the phone and they'll have a conversation with you. They'll say, hey, yeah, we're really struggling. Give us some debatement, give us some abatement, deferment, et cetera. We're going to work hard to catch you back up. So it's a lot easier to deal with those mom and pop businesses. You don't have the credit, but you can at least get in touch with a human. In many cases, through COVID, when the tenants, asked for these various things, they weren't able to administratively handle the changes, right? So they asked for an abatement across 1,000 landlords, but then you can't get somebody on the phone to actually do an amendment to memorialize the abatement. So I mean, I'll give you an example. I have a tenant in my portfolio, and it's a big public company, and they told me they weren't paying rent. And I said, okay, well, let's talk about it. Couldn't get them on the phone. Rent didn't show up. Eventually, I just sent them a default notice, and then the next month, my back rent showed up and the current month's rent showed up. So they just never heard from them again. They just paid rent in full. But it's a shame that you have to default, that the rule of law and the sanctity or that actual lease, that piece of paper, if that doesn't mean something, right? And if some judge rules that leases don't mean something, that's a big problem. It's the fabric on which our business exists. So.
Nice, man. Well, hey, I know we're coming up to the top of the hour here. A lot of good info, man. Anything you want to impart on us? Just, anything else? Predictions? What's going to happen? Is it going to be tough for the next couple of months? What about the stock market too? You think that's going to still be on the highs that it's going? I think that might be a whole nother tangent. We don't have to go there.
Yeah. Well, short answer is I think it was oversold, but it's been overbought. I think it's due for another correction back down. I don't think it's going to fall precipitously, but the effects of 20 million unemployed people we are not going to see those in corporate earnings for another quarter or two here, but there's going to be a lot of bad news coming this fall. There are still great assets to buy. There are good areas to invest money defensively, particularly in net lease. But I think we face some pretty strong headwinds, and there are concerns out there. I do think brokerage revenue-wise, if you own a brokerage company, if you're working in the space, save your money, because you are not going to generate the same kind of income you were in previous years. Brokers are advertising things like, okay, still closing deals during COVID, et cetera. Sure, we're doing the same thing. We're still closing transactions, but the fallacy in that sort of marketing is that those transactions originated or were in escrow prior to COVID happening, where those buyers were in a 1031 exchange. They have to go reinvest. I can't tell you how many investors, a couple of them walked from deposits. Other ones said, hey, look, I'm so nervous I might actually pay taxes. So, but I don't think we have seen the worst of what this COVID situation has done, and it's going to be reflected a couple months from now. We're still thinking everything's okay, but it's the residual effects from Q1. Remember, COVID hit at the very end of Q1, so Q1 numbers and even the very beginning of Q2 really wasn't the worst of it.
Still hot, yeah. Yeah, no, good point there, man. Well, I really appreciate everything you're instilling on us from the economy, your overall, general knowledge that you've got in the space. Question just from a personal standpoint that I always want to ask, are you an Audible guy or are you a physical book guy? I know you do a lot of traveling. I got to assume, you're typically on the road, 150 days a year?
I was. I got on a plane for the first time a week ago. It was pretty disgusting.
I'm going July 1st, so I'm excited for that.
I'm excited to get back on the road. I'm a hard paper guy. I get my
Hard book? Okay.
hard book. I recycle, but I get my Wall Street Journal delivered every day in paper. Probably stupid, but
Wow.
like
Even a millennial still doing that, man. You're keeping them alive. I like that. You got to do your part. You got to do your part. Anything you're currently reading right now you'd recommend, or what are you?
I don't read for pleasure much. I read too
Okay.
much. I read Leases all day for a living, and the news. So, it's hard for me to unwind by reading a book. I should get into it, but I've been watching my Billions on Amazon. So my buddy Bobby,
Nice, man.
that's how
Yeah.
I unwind.
Absolutely, absolutely. Well, hey, I really, really appreciate the time today, Patrick. I know you're busy, so I think from everyone out here, thank you so much for the info and the knowledge, and thanks everyone for joining us today. We'll be back next week, and yeah.
You guys have any if anybody has questions for me, my email's out there,
Yeah,
and just email me direct. It's no problem. I respond to anything I receive. So
we had a lot of questions we couldn't get to just because we're getting to the top of the hour. So I
I'm
don't know
happy to answer.
if you want to say, I don't know if you want to shout your email out to everybody. I can put it in that follow-up email too.
Good. Yeah, it's just patrick.luther@srsre.com.
Awesome, man. I'll be sure to put it on the email to everybody too.
Thanks, amigo. This was fun.
Thank you, my friend. Good times. Stay well, stay safe out there. And everyone that joined, same to you guys.
Thanks for having me. Thanks for the questions. Bye-bye.
Yep. Have a good one, man.